Did you know that divorce can actually kill your life insurance policy? Or at the very least, completely gut its purpose, and most people don't find out until it's too late? We're talking about a legal and financial blind spot that affects millions of divorcing couples every single year. And the stakes couldn't be higher. When a marriage ends, the courtroom doesn't just divide furniture and retirement accounts, it reaches directly into your financial safety net and starts making decisions for you. Life insurance, which most people treat like a set it and forget it product, suddenly becomes one of the most contested and consequential assets in the entire settlement. Here's the core issue. Life insurance serves two completely different masters in a divorce. It's both a financial asset with real cash value and a future obligation tied to support payments. Think of it like a Swiss Army knife that one side wants to keep closed and the other desperately needs open. The catalyst for most of the drama is spousal and child support, because if the paying spouse dies, those monthly obligations die with them. And courts have figured out that life insurance is the most elegant solution to that problem. Judges across the country are now routinely ordering divorcing spouses to maintain policies as a condition of the settlement, essentially turning a private financial product into a court-enforced promise. There's a term you need to know: security for support obligations, which is just legal language for the court saying, we don't trust you to stay alive and financially responsible, so prove it with a policy. The irony here is that two people who can't agree on who gets the couch are now legally bound together through a financial instrument that only pays out when one of them is dead. A common misconception is that once the divorce is final, you can simply update your beneficiary and move on, but that's where people walk straight into legal landmines. In many states, if a court order requires you to maintain your ex-spouse as a beneficiary for support security, changing that designation could be considered contempt of court, regardless of what the policy paperwork says. The distinction between irrevocable beneficiary and revocable beneficiary is everything in this context, and most people learn the difference the hard way. An irrevocable beneficiary designation means your ex-spouse has vested rights in that policy. You literally cannot change it, surrender it, or let it lapse without their written consent. And that's a clause divorce attorneys are increasingly writing into settlements. Historically, courts have oscillated between treating life insurance as a purely private matter and a public obligation, and the trend since the 1990s has moved decisively toward enforcement and protection. We've seen landmark cases where states were sued, children went unprotected, and surviving ex-spouses received nothing because nobody pinned down the policy details in the divorce decree. The practical lesson history offers us is this: get specific in the decree policy, number, face amount, premium responsibility, and duration of obligation all need to be spelled out with surgical precision. A vague instruction like maintain life insurance has been interpreted 1,000 different ways in 1,000 different courtrooms, and ambiguity in legal documents is just expensive confusion waiting to happen. Now, what about the cash value in a whole life or a universal life policy accumulated during the marriage? That accumulated value is often considered a marital asset subject to division, meaning your spouse could be entitled to half of what you've been quietly building for decades. Think of it like a savings account that nobody labeled correctly, and now a judge gets to label it for you. The misconception worth dismantling is that term life insurance has no value in a divorce, while it carries no cash surrender value. Its protective value for support obligations is enormous, and courts treat it accordingly. Requiring a paying spouse to carry a $500,000 term policy isn't punitive. It's the legal system doing what private contracts should have done in the first place. The discipline move, whether you're the obligated spouse or the protected one, is to work with both a family law attorney and a financial planner who understands insurance mechanics, because these two worlds rarely speak the same language on their own. Don't rely on your divorce attorney to understand policy illustrations. And don't rely on your insurance agent to understand family court orders. You need both in the room. At its philosophical core, this entire issue is a reminder that financial planning doesn't pause for personal crisis. In fact, crisis is precisely when the gaps in your planning become the most expensive. Discipline here means not just signing the decree and walking away, but actually verifying the policy exists, the premiums are paid, and the court order is reflected in the carrier's records. The beautiful, if slightly absurd, silver lining is that life insurance in divorce forces two people who no longer want anything to do with each other to remain financially accountable to one another, sometimes for decades. And in that strange, legally mandated entanglement, children get protected, support obligations get honored, and the financial promises made in a courtroom actually have a mechanism for survival. Whether you're navigating a divorce settlement, protecting yourself as an ex-spouse, or simply trying to make sense of how your existing coverage fits into your financial future, we can help you find the right lenders, coverage, and professional guidance. Check out our links in the description below.